Welcome to Chapter 9, Acquiring and Using Funds or Money to Maximize Value. In this chapter, we're going to take a look at identifying the goal of financial management and to explain some of the issues that financial managers confront as they seek to achieve this goal. We'll describe the tools financial managers use to evaluate their company's current financial condition and develop financial plans. We'll evaluate the major sources of funds available to meet a firm's short-term and long-term financial needs. We'll identify the key issues involved in determining a firm's capital structure. Describe how financial managers acquire and manage current assets. And finally, explain how financial managers evaluate capital budgeting proposals to identify the best long-term investment options for their company. Now, a brief overview of financial management. We have financial capital, which is financial capital is funds that a firm uses to purchase assets and how it finances its daily operations. And then within that, or as part of the overview of financial management, we have general finance. And that is referring to the functional area of businesses that are responsible for finding the best sources of funds and finding the best ways to use them. This is different from accounting. Accounting refers to the day-to-day use of money. This is thinking much bigger. So a portion of a firm's capital is used to fulfill short-term obligations, like paying for bills from suppliers and meeting payroll and so on. Other funds are used for long-term investments, like purchasing a plant or equipment, launching a new product line, doing research, etc. The finance department chooses the best sources of funds for the business. How are they going to be able to afford this? It also chooses the best method for utilizing the funds. And the sources and users are chosen based on the goals set by financial managers. Now, part of this process is evaluating and planning where will the company be moving in the future. What are its financial goals? So companies look at different ratios. And they do that, they look at these ratios, and the ratios provide some analysis that financial managers use to access the firm's current weaknesses and strengths. These analyses calculate the ratios that help compare the major accounts listed in the firm's balance sheets and income statement. And while the use of leverage, which is the use of debt in a firm's capital structure, while that can benefit a firm when times are good, a high degree of leverage is very risky because that means that you may owe too much money and you don't want to be upside down in terms of owing more than you're bringing in. That's a recipe for financial disaster. Now, some of the key ratios that financial planners use, we have the current ratio, which looks at a firm's liquidity. And liquidity refers to how is a firm able to pay their short-term bills. There's inventory turnover, which is asset management. Is the firm using their assets in an efficient manner? And then we have average collection period, which is a measurement of how effectively a firm is using its assets to generate revenue. Some additional key financial ratios, we have debt to assets ratio, which again looks at the leverage that a company can use to, is it using its debt to meet its current financing needs? Return on equity. Return on equity. This is a measurement of profitability. And finally, we have earnings per share, and this is for publicly traded companies. And again, this looks at the profitability of the company and how much the company is, if you take all the shares that are owned, how much revenue is being generated by those shares. And all of these ratios are located in the vocabulary document, so I would suggest taking a look at those in that class resource page. Now, financial planners have to use certain tools to get the information that they need. They have to have a budgeted income statement that shows how the firm's budgeted sales and costs are going to impact net income. The budgeted balance sheet that is used for forecasting, and that helps the financial planner figure out how the assets of the firms are the right assets in the right place for future plans, future expansion, meeting current consumer needs. And if you don't have the assets in place, then do you have the financing available in order to purchase those assets? And then finally, we have the cash budget, which shows the detailed forecast of future cash flows and both inflows and outflows. And it helps financial managers understand the timing of the cash flows. So you may have more money coming in at the beginning of the month rather than the end of the month. Now, we have sources of funding. One is trade credit. So trade credit is a type of short-term financing that firms use when they don't need to make an immediate payment to the supplier on the delivery of goods. So usually suppliers include the terms of trade credits in their invoices. And these trade credits are at times known as spontaneous financing. So that's when the supplier says, all right, I'll give you a 10% discount if you pay your bill in full within 10 days. Large firms use this, but also small firms, and especially small firms, they really rely on this type of financing. And this is a less, while the terms of this type of financing are certainly written out, it is not, you don't see the type of documentation that you would with loans. Now, factoring. So cash that is owed to a firm during credit sales is shown on the accounts receivable ledger on the company's balance sheet. And a firm will use factoring when it's looking at its overall financial picture to say, oh, we have this money coming in, but we don't have it yet. But it's a way for getting early credit for those funds that are coming in. The firm is also able to save money because it eliminates its own collection department. And when you have those types of deals negotiated up front, it can, especially with a reputable customer, it can really save the company, both companies, a lot of money. Now, banks are also a source of financing, And banks do provide businesses with short-term financing in the form of loans that are due anywhere between 30 to 90 days, sometimes even a year. So these are all considered short-term. They may also provide a line of credit or a revolving credit agreement, and these are also considered short-term bank loans. And they are definitely legally binding, and a company that uses either of these forms of credit is making a financial obligation to pay it back. And then we have commercial paper, and these are issued by large corporations that have very, very strong credit ratings. So commercial papers can be issued for a maximum of 270 days, and really they are promissory notes that are written by large corporations. Now, another way that corporations are able to finance themselves, they have direct funding, and that happens when investments are coming directly from owners. And an owner can be someone who purchases stock. An example is recently Oprah Winfrey decided to become a 10% owner in Weight Watchers, and she now owns 10% of the stock of that company. We have retained earnings, and these are profits that a firm will take and reinvest into the company. And this reinvestment will help to finance the purchase of assets, pay off loans, and possibly reinvest in other areas in the company. Now, long-term debt, we have companies will take out long-term debt, usually from banks, and sometimes they'll issue bonds. So there are term loans, and these types of loans ensure that a firm repays the principal and the interest by making small payments at regular intervals. And although the lenders do profit from these agreements, borrowers do find them pretty restrictive because of all the conditions that there are. Corporate bonds are another way that companies can finance long-term projects, and a corporate bond is a long-term IOU that they will sell to investors. Now, when we're looking at the capital structure of a company, remember, capital is referring to the extent to which a firm depends on different forms of debt and equity in order to meet its financial needs. So when we're looking at in the world of finance, we're talking about capital at this point. So we have equity financing, and that is provided by the owners of the company. And then we have debt financing, and that is funding that's provided by lenders, usually in the form of banks. Now, some advantages of debt financing is usually interest payments are tax deductible for a firm, and a firm can acquire more money without selling more stock, which means they're retaining more of their own ownership, and they also don't have to make stockholders invest more. So those are some real advantages. Some disadvantages: you have to make your interest payments, and if you have too many loans, it can certainly put a firm into a firm that doesn't have the income. It can lead to bankruptcy. Sometimes the terms of the loan can hamper a firm's flexibility. And a lot of times for stockholders, they earn dividends if the company has a very profitable year. Well, if there are loans that have to be repaid, those payments are made first before stockholders are being paid their dividend. And stockholders don't usually like that too much. Now, equity financing is typically more flexible and less risky than debt financing, and it doesn't impose required payments. There are no restricting covenants. A disadvantage to equity financing is it doesn't yield tax benefits. Existing owners might not want a firm to issue more stock. So as a stockholder, I might want to retain my 10% ownership and not have that diluted down to 5%. And the firm forgoes the opportunity to use any financial leverage. And you're always trying to look for the best opportunity for the firm, which method makes the most sense. So, how financial leverage affects the return on equity? And I apologize, my phone is ringing. I don't know if you can hear it, but if you can, I apologize. I'm not answering it. So, the way that a firm, so this exhibit illustrates the advantages and disadvantages of financial leverage. So the exhibit shows that revenues, expenses, and earnings that this particular organization, Equity and Oosmore, so what they would experience with two different types of sales levels. So one represents a great year, one represents a very poor year. So for Equity, they used equity financing, and what that resulted in was a lower return on equity of 12% and 6% versus when we look at Oosmore, they had a very strong sales, and that resulted in a 30% return on equity. So that is very strong. But what's interesting is that when sales are weak, Equity will have a stronger return on equity than Oosmore. And so you can see that it's very difficult to analyze the financial leverage that a company has, but you have to really be able to dig into the background, what is going on with that firm, what is going on in their market to understand, is it in a good place financially or is it not? Now, the Dodd-Frank Act was established to avert financial meltdowns. And this act was established a Financial Stability Oversight Council to monitor financial markets and to identify and respond to any emerging risks. We saw that in the housing crisis that happened in the last decade, and also in the banking crisis. So the act also established a Consumer Financial Protection Bureau, and that was done to protect consumers from predatory lending practices. So it was a very good act to make sure that consumers aren't being taken advantage of, and if too many companies within a large segment in the economy, if too many are at risk, then that's not good for the U.S. economy, and it helps to oversee that. Now, current asset handling. So, in a very small sense, a firm's cash includes the currency and the demand deposits that it holds. So, these are considered cash equivalents and cash equivalency. So, the most common we have is commercial paper, US Treasury bills, also known as T bills, and we have money market mutual funds. Now, the maturity period for most T-bills is 4, 13, or 26 weeks. And T-bills are highly, highly liquid. Now, the type of investor that usually invests in money markets tend to be small investors because money market mutual funds tend to pay a higher interest rate than a savings account will, but it's still a very safe investment. So current asset handling. So when you're thinking about a balance sheet and your current assets, the way that many of these assets are handled is that, especially in accounts receivable, it allows customers to buy on credit, and this is important because it can significantly increase sales. However, credit sales can create cash flow problems because they do delay the receipt of cash from the firm's needs that the firm needs to meet its financial obligations. So, to manage this, it's very important to have set credit terms, to establish credit standards, and if needed, have an appropriate collection policy if you're not getting paid. Now, an example of an aggressive collection policy, why might you want one? You might want one to really go after those funds that customers aren't paying you for, and you can sometimes collect sooner rather than later. Some small businesses have found that being flexible and creative about their form of payment can help them get at least some of what they are owed. So maybe 50% of what they're owed rather than all of it. But 50% is better than nothing. Sometimes we can have barter arrangements that work better than demanding cash, and that is certainly another creative way to manage assets. And finally, firms try to keep inventories relatively low to reduce their costs and to improve efficiency. So when we were looking at the economics chapter, which was chapter 2, we talked about the equilibrium price point between supply and demand. So firms try to keep inventory low so they're not tying up too much money in inventory waiting for those sales. So how do you evaluate budget proposals? So during capital budgeting, which is used to evaluate long-term investment proposals, a firm evaluates proposals that are related to replacing old machinery and equipment, buying additional plant facilities, machinery, and new equipment. They look at the time value of money. So time value is the idea that a dollar received today is worth more than a dollar received in the future. So they compare different cash flows that take place at different times. So that is how that's looked at. And then they also take a look at the CDs, certificate of deposits. Now, a CD is an interest earning deposit that requires money to remain deposited for a certain amount of time, 3 months, 6 months, 5 years. So A CD, it's like a savings account, but the funds have to stay in that account for that fixed period or there are penalties applied. But that is looked at when the overall budget is being reviewed. The present value of money. So the present value is how much is the money invested today at a given interest rate. How will it grow to a future amount within a certain period of time? There's the risk-return trade-off. So typically, a higher discount rate is used for present values of cash if the project is very risky. And then we have the net present value, and that is used to evaluate capital budgeting proposals. If the net present value is positive, the present value of the expected cash flow from the project is said to be more than the cost of the project. And that is very, very positive. So if the net present value is greater than or equal to 0, a financial manager will accept that proposal. If it is less than 0, that means that the project is going to cost more than you can ever expect to earn money on. So that's really not a good investment. Then that proposal is rejected. So looking back over this chapter, and this is just a very, I'm going to call this a 10,000 foot level at the world of finance, because there are many classes that deal with finance, and there are lots and lots of books, and this is just one little itty bitty chapter. So looking back, we've identified the goal of financial management and explained the issues financial managers confront as they seek to achieve this goal. We've looked at some tools, that would be the ratios, that financial planners use to evaluate their company's current financial condition and how to use those ratios to develop financial plans. We've evaluated the major sources of funds available to meet a firm's short-term and long-term financial needs. We've identified the key issues involved in determining a firm's capital structure. We've described how financial managers acquire and manage current assets. And finally, we've looked at how financial managers evaluate capital budgeting proposals to identify the best long-term investment options for their company, and that is the net present value analysis that we were just looking at. So this concludes Chapter 9. My recommendation is that you look through the vocabulary terms for this chapter and watch this lecture, watch and listen to this lecture again in preparation for the quiz. And be sure to look at Buzz for any other assignments that are coming due in the next week. Thank you so much for your time and attention, and if you have any questions, please give me a call. Bye-bye.